Traders, how are you? Welcome to another edition of the Institutional Weekly, the #1 trading program, I guess you could call it, on YouTube, about trading, about institutional trading. You can see, special today. I'm outside, a little bit cold, right? If you're ready to drop the garbage and actually see what's driving markets, then you can join me inside. I've got an amazing edition for you today. I've got my results. I'm actually going to go through every single fill, so some of you have known I'm not on Instagram at the moment, or cutting it down for my mental health, so I'm going to show a lot more of my trading here. So we'll have a look at that towards the end, how I've performed, about $3,000 over the last week. We're also going to have a look, as we always do, at what's driving markets. Some amazing stuff, right? So a lot of data come out over the week, inflation, earnings. Basically, it's going to be quite a short session, to be honest, because every single thing I've talked about in all the institutional Sundays recently, let's be honest, it's all come to fruition, right? And at the end of the day, every single thing I've said has basically happened, right? The seasonals, negative seasonals in September, the positive seasonals in October. I talked about earnings reports, beats in the financial sector this week will more than likely drive the market. And that's basically what's happened. There's obviously some risks in terms of inflation and crude oil and bond prices selling off as well. So we're going to talk about that very briefly. But all in all, an amazing session for you. Let's go inside. Okay, so we're inside. You can have a look and see some of the upside factors versus the downside factors. It's still a bit chilly in here, so keep my jacket on. But looking in all seriousness, looking at the factors, and I know a lot of people will be like, I just want to have a look at the P&L and all of this. And that's the reason I do all this stuff, is because I don't think enough people look at the factors that are driving markets, whether it's things that are not on a price chart, whether that be order flow, whether that be fundamentals, whatever you're looking at. People get very excited about all these bells and whistles jumping around, right, on their price chart, which are pretty much meaningless, right? Either you got to dedicate your time towards order flow, or if you're going to do fundamentals, look at the things that are driving markets. The reason I do a lot of this type of stuff every week, and it does take time, I've said it every time, it's taken me about 12-13 hours I've spent preparing for this, is because I want people to see how much work is involved when I do present you results, and when I do say, hey, I've had a $10,000 week, or I've had a $3,000 week, or I've had a $20,000 week. It's not some squiggly lines and bounces, and it's not that easy, right? It takes incredible amount of work, and that's why I do it, and if people aren't interested in following along and actually seeing what's actually driving markets, well then might as well go down the fruit machine, right? No point watching any YouTube videos. But anyway, we're going to crack on. The point is that a lot of work has gone into this, and that's why I'm going through these in so much detail, because all these things were in my mind this week. Earnings we're going to discuss very briefly. Some of the risks which still persist in terms of labor costs, supply disruptions are obviously still there, we know, with energy prices, right? Transportation issues, obviously lack of people getting back into work, although we did see unemployment claims hit a kind of post-pandemic low, so that was good news. Crude oil, energy stocks, we're going to talk about that briefly. Inflation is quite persistent at the moment. We had the inflation release last week, and rate rises, I've put it twice here. Obviously, bond yields still starting to really press ahead, still at relatively low levels, and even on an absolute basis, still at low levels, but starting to hit like 1.6%, which obviously could be a factor going forward. That's why I mention it here. Let's jump into earnings. Okay, so I said we'd start with earnings, but actually, kind of makes more sense to just have a very brief recap of the week before we get into the details. So Monday, we did have a little bit of a sell-off, sort of continuing from the previous session on Friday, and then Tuesday we just sort of consolidated Wednesday we then picked up, which was quite surprising because the inflation data was fairly strong, and FOMC minutes obviously came out and confirmed the tapering. So you would have thought that would have been quite a flattish day, but obviously it ended up being up. I think market was positioning ahead of financial earnings, which kind of started later in the week towards Wednesday, Thursday, and obviously a strong claims number, which was a big surprise as well. So that drove us higher by almost 2% in one day. It was an incredible day. A lot of the move happened overnight, as a lot of you will know, big gap, and then a very strong retail sales number on the Friday. So early in the week, as the market was just waiting for data and earnings to really kick off, market was obviously just a little bit tentative, and it kind of caught me a little bit by surprise. I was expecting the market to start rallying much earlier in the week, and that's probably why I only did 2.5k last week rather than take full advantage of obviously was expecting this move, but I just wasn't able to take full advantage of, and we'll have a look at that anyway in a moment. Again, like I said, let's just get on to earnings, because that's the first thing I want to talk about, which was the major driver, as you can see, on Thursday. So here we can see the earnings reports from last week. You can see financials, obviously the heavy sector there. So 8% of the S&P has actually reported earnings in the week, so still fairly early, but as I talked about in last week's Institutional Weekly, financials heavily reporting, and look, 100% of them beat estimates. The surprise was around a 23% earnings beat, and actually overall, when you include all the other sectors that reported last week, I think this table was updated on Thursday. If you include Friday, I believe the EPS surprise was even bigger, around 12-13%. 5-year average is around 8%. So, heavy beating of earnings estimates. Number of companies beating estimates up at, I believe it was almost 80% by the end of Friday. So again, well above the 5-year average. So is it any surprise that we saw such a strong reaction? And actually, you've got to remember also that a lot of the financials, just from what I was reading, obviously I didn't dig into their details of the earnings report, but in general, I believe loan demand was very, very high. So some of the banks, right, talking about loan demand being very, very high. Why is that important? Because that means consumers are obviously spending, right? If there's demand out there, for credit, essentially, not only from consumers but also from businesses, right? Consumer and businesses. Credit demand, loan demand from businesses also very, very high. That's very, very good indicator that people are still spending despite some of those risks being there, inflation and obviously some of the supply concerns. So next we're going to actually look at inflation, which was one of the downsides from last week. So let's just go and have a look at that. So here we can see the inflation number, which headline actually came in at 0.4% month on month, and then the core was 0.2%. And actually, if you think about it, I was talking about this, right, when I did the summary of the week. It was released on the Wednesday, and we had quite a positive reaction on the Wednesday. So I think the market probably priced some of this in on Monday, Tuesday, which is potentially why we had the sell-off and a more of a positive reaction to this, because obviously this isn't necessarily good news, right? Inflation, the Fed has talked about it being transitory. These numbers are anything but transitory, right? It's been coming down, the headline rate, but you can see here it's quite persistent, right? Even on a core basis, back up at 0.2%. Definitely not what you want to see if you're looking for the Fed to maintain loose policy, right? With these type of numbers, obviously it's likely that some of this tapering process is going to have to be accelerated. And that's obviously a potential headwind, and why we're seeing so much volatility in the market, because there is some uncertainty around inflation, and it's not dropping off as much as the Fed has been talking about, and investors are obviously nervous about that, which is why I was surprised that the market still rallied on it. But like I said, potentially that may explain why on Monday, Tuesday we had the sell-off. So inflation was one of the other concerns. Let's move on to one of the positives now. So claims. So here you can see the claims number, very, very positive number, right? So I think it was just under 300,000, 293,000. I think I got it written down here. Yeah, 293,000. Post-pandemic low, right? So you can see why the market had such a strong reaction on Thursday, because this combined with earnings just really propelled the market. And this is a good sign, hopefully we've had some softening in the payrolls data. As you know, the last couple have been quite soft. So this could be a good leading sign that things are starting to turn again in the labor market, and hopefully we see some of this feed through into the payrolls number, which is obviously very, very positive. And actually, just one thing, I'm going to jump around a little bit here. I talked about this inflation number. One of the things that I forgot to mention that definitely worth keeping an eye on, if you actually look at the breakdown of the inflation number, so I talked about 0.4% on the headline, month on month, right? 0.4%, which has been quite sticky, right? You can see it here. It was starting to come down and now it's shot back up. Surprisingly, and I heard a lot of chatter about this in the market, one of the things that's driven that, owner's equivalent rent, right? Normally you'd expect things like automotives and gasoline. Amazing, I'm using these words even though I live in the UK. It's a US word, but all good. Gasoline and autos are normally the drivers around headline inflation. You can see owner's equivalent rent this time starting to creep in there as a driver. So definitely something I've heard that a lot of traders are going to be keeping an eye on for the next couple of months. The first time it's actually come in there as being the number one driver in the month, but definitely something worth looking at. So just to summarize, we started off the week with obviously inflation data, which looks like Monday, Tuesday, the market might have been anticipating a stronger number or been a bit nervous around that, and that's why we sold off earlier in the week. And then Thursday, huge claims number and also very positive financial sector earnings, which drove the market higher. And then finally, we ended off with very strong retail sales number, which you can see here, 0.8% on the core, and but the headline was 0.7%, which was expected to actually be down 0.2%, which obviously was very, very strong. And actually I believe it was just under, on a year-on-year basis, around 14% year-on-year. Okay, so very strong retail sales, suggesting that consumer spending, which we've seen many signs of being very resilient, but consumer spending will continue to push forward despite some of the headwinds that we've seen, with inflation, as we just discussed. Obviously with the crude oil, energy prices rising, we just saw owner's equivalent rent, many headwinds, and COVID. Consumer seems to be quite resilient at the moment. We'll see. This is why inflation is, for me, could be one of the red herrings, right? We'll have to see, but it's quite a big risk because, end of the day, there's only so much inflation that companies can pass on to the consumer. So, there's going to be a breaking point at some point. If it doesn't obviously abate in any way, then we could see some issues. So going into next week, before I just talk about performance, dead calendar, literally a dead calendar. We've got some housing data, which hasn't even made like the red news or orange news. Very low level news, some housing data. I don't think the market's going to be focusing on that. We've obviously got more earnings coming in, so earnings will be very, very important. I personally will be watching for earnings, but more than that, this is what I'm going to be looking at. All right, crude oil and bonds. So you've got crude oil basically continuing to get rampant, which probably did drive equity markets to an extent, obviously as the risk on rally was in effect. We also saw, though, bond yields, I talked about it before, still strong, very, very strong. So it'll be interesting to see what impact that has. So far, it hasn't had a negative impact because the levels are so low. But if that just keeps going up and up and up, at some point it will have some equity investors thinking, hang on, maybe some uncertainty, maybe lightening the load in terms of what may happen. Crude oil obviously going up as well, inflationary impact. On the positive side, obviously helps financials, energy stocks. So we'll see. My gut feeling is that some of these moves will calm down a little bit, and I think we're going to see all-time highs again, if not this week, possibly the week after. So I'm still very bullish on equities, as I always have been, right? Throughout this sell-off, I always said, if you go back and watch all the Institutional Sundays, I always said it makes no sense to me this sell-off being anything but a correction, right? And that's what it ended up being. It was just a correction. And what are we? 1.9%, about a couple of percent off the highs, right? It seems to me inevitable we're going to go back to the highs. So everything has played out exactly as I thought. So let's go and have a look at the fills from the last week and then wrap it up. So this was last week's performance. Didn't trade on Thursday when we had the big gap up overnight. Obviously it was like, oof, that was a incredible move. Was a little bit uncertain whether I wanted to participate in that because obviously it just went up and up and up. Friday I did have a small trade, which you can see over here. Very small trade. Got in late into the market, just under $400. Wednesday was $450. Good day on Tuesday, $12.87, and then $6.50 on the Monday. We're gonna go through all of these. So just under 3K last week. So that was Friday, as you can see, just taking advantage of the rally, but didn't catch as much as I really wanted to. Then on Thursday, like I said, didn't really participate in that move because big gap up overnight. Obviously didn't want to take advantage of that. Well, it's not that I didn't want to take advantage of it, I just felt that it was difficult, didn't want to chase it really. So this is where I said at the start of the week I was a little bit caught off guard by that slight sell-off early in the week. Like I said, I was trying to, as you can see, buy the market here on Tuesday, tried to buy the market on Wednesday. It wasn't quite working out as I wanted it to, came back rotational, still made money, but obviously just wasn't able to gain any traction. Wednesday, from a rotational environment, buying the market. If we just go back to, and then Monday, I know some of my students want to be looking at this stuff just to kind of, like I said, you're used to seeing my stuff on Instagram and I haven't been on there recently, so that was it. A little bit of buying on the Monday, so a bit of a topsy-turvy start to the week. Obviously threw me off a little bit, didn't give me enough confidence to hold any of the move on Thursday, Friday. So hopefully that was useful for you. Just kind of wrap up with breaking down some of the performance. So not bad. I mean, obviously the MAE was very light, but that's because we had a one-way market, so it didn't need much risk. You're talking almost 3-4 times risk reward. Incredible risk reward here. Average winning trade 687. Average MAE, which I don't ever hear anyone talking about, because they're living in dreamland, right? And they don't have a clue what they're doing. If they don't talk about this, I'm sure there are those that do, but don't hear it enough. So minus 170 on that. And actually what I wanted to show was just my whole month. So if we actually go and look at the whole month from the start of the month, you can kind of see I've been very tentative, right? So 18K for the month, so obviously, no complaints by any means, but look at what's been happening. Got very aggressive as the start of the month, but funnily, the more aggressive the market has got, the less aggressive I have got because of kind of this exponential move. I don't know whether it's psychological or what, it doesn't matter. It's something that I'll obviously be dealing with and thinking about, even after all these years. Still plenty to learn. Hopefully that was useful for you. Can't wait till the next weekly outlook. Look, if it was useful for you, hit the, I don't know where it is, somewhere here, hit the subscribe button so you get these sent to you automatically. Have a great week.